our keynote speaker tonight is Justin Ferguson, our very own pre-college initiative chair. And before we kind of get to that, every meeting, we like to start off with the Espp mission. And so the Espp mission, you can say it to yourself on mute. If we were in person, it would be, a thing we could all say together, but to increase the number of culturally responsible Black engineers who excel academically, succeed professionally, and positively impact the community. And the Espp Professionals value proposition is something that we started doing. This is for specifically around the Espp Professionals division of Espp. And the Espp Professionals inspire the next generation of technical professionals and serve as a catalyst for transforming the culture of engineering. And so that is all of the reasons why we are active in Espp and why we are trying to have these programs and events through the Espp Professionals. So now I will just give me one brief moment. I'll introduce our speaker, Justin Ferguson, who, as I mentioned, is our pre-college initiative chair for the RTV Espp chapter. Justin Ferguson is originally from Greensboro, North Carolina, where he's a graduate of Dudley High School in Greensboro. He has an undergraduate degree in industrial and systems engineering from North Carolina State University and a master's degree from Wake Forest University in business analytics. And his current role is he's a product manager at SAS and is currently working with his fraternity brother to develop a financial literacy learning platform. And so with that being said, please give a round of virtual applause for Justin Ferguson. And sorry that I just realized I didn't adjust the company. So sorry about that. But
thank you for the introduction.
You're welcome.
Do you want me to, can I still share from you or?
Yeah.
Okay. Give me a second. And as people come in, I'm gonna rely on you to admit them because I can't anymore.
Okay.
Let's see. All right. Can everybody see my screen?
Okay.
All right, smooth, sounds good. All right. So as Elliot mentioned, I'm Justin Ferguson, and I wanted to put this slide deck together really for a couple reasons, right? I wanted to kind of demystify what I think has been traditionally complex or seemed to be complex knowledge in the space of money and finance. And I think for me and maybe even the broader Black community, I think it's always been taboo to talk about money. And that could be from a standpoint of just not feeling comfortable, or it could just be from the standpoint of, you just didn't know, right? So with this talk, I named it Money Talk because, let money do the talking at the end of the day. So hopefully you guys get something beneficial out of this. And I do want to let you guys know, I want this to be as interactive as possible. So, I do have some pop quizzes throughout the presentation just to make sure that y'all are paying attention. And it would mean the world to me if you get off mute, maybe turn your camera on if you want. If you can't turn your camera on, that's fine. But really, I want this to be as interactive as possible so that, you feel like you're getting the most out of the presentation. So with that being said, let's go to the next slide. So I wanted to be very intentional about this agenda. I wanted to start by building a strong foundation, right? So that's going to be in the realm of personal finance. I wanted to then move into work because A lot of people, when they go into their first jobs or maybe they're transitioning jobs, there's a lot of information around benefits, maybe some stock plans. You really don't know, you're really not, made aware of all the options and all the resources and how you should navigate that. So hopefully I can answer some of those questions. Family is a big part, at least of my life. So giving people some options of investment opportunities for family. And then we'll talk about each of you guys' individual journey. And then we'll get into some pro tips, and then we'll close with Q&A. I do want to give a disclaimer. I'm not a financial advisor, so all of these perspectives would be pretty much from my perspective, right? I'm not trying to sway you one way or another. My job is really just to consolidate all of this information together and present it to you in an easily digestible way. All right, so let's get started. Personal finance. So the first thing I want to do, and I think this is a very important step, is talk about what specifically a freedom plan is, right? And it sounds more glamorous than it actually is, but I want to start with this idea of not necessarily thinking of a budget as, a budget, right? Because budgets typically have a negative connotation. Most people think of it like, all right, well, it's not in the budget, I can't afford it, or it's not in or I can't do this because I haven't accounted for it in my budget. I want to kind of get out of that thinking, right? I want people to think about budgets or freedom plan this way as a way to actually get free ultimately, right? So what I want you guys to do is when you're actually putting together this freedom plan, I want you to think about, all right, how long is it realistically going to take me to get to the point where I don't even have to look at this budget anymore? And so that's kind of the approach that I took with a lot of these concepts. I wanted to make sure that you guys really felt comfortable with this foundational period, and then we can move forward to a little bit more of the complex topics. So I wanted to give kind of a simple example of a budget, right? When you think about a budget, you want to just kind of put everything that you spend money on in there, right? You can include things like the house, things like the internet, but you also can include things like a haircut, right? Things like car insurance, your specific credit cards if you have more than one, a spouse, maybe you have a specific amount of money that you want to give to your spouse. That's the thing as well. So I want you to kind of be practical with everything that you're spending money on, just so that you can kind of keep yourself accountable, and so that you can honestly know, where your money is going. And, after you actually pay it off, after you actually pay off each of these fees, keep track of it, right? So here I like to update, I like to come in and update just to double check myself and mark it as green after I've actually paid it off. And some people may say, well, you know what, Justin, I don't really think that I'm gonna be able to keep up with this, or I'm not really as detail oriented. There are apps that assist with this as well. I personally use Mint. I definitely recommend that. And they will actually link with your card. So that way it takes all right, I got to make a list of everything I spend out of the equation. And it just provides you with an easy to use platform to keep track of everything for you. And you'll be surprised too. Once you create this freedom fund, you'll be surprised at how much money is actually going out of your paycheck every single month. So, I mean, even looking at these prices, right? Like, I don't think that there's an apartment, especially not in the RDU area, that's $1,200 at this point anymore. But once you calculate all of these totals, you realize that you're spending about $3,000, right? So we want to be realistic too. You know what I mean? If you know that, or you think you're going to spend $250 in gas, put $300 on there just to be on the safe side, just so that you can account for those high months. And if you come up short, that's great. One additional thing with this freedom plan that is a benefit, I think, is really starting to understand what this emergency fund is going to look like. So with an emergency fund, you really just want to keep a tally of all of your expenses, right? And the reason why you want to keep a tally of all of your expenses is because if we're in the frame of a freedom plan being our way to freedom, right? We want to be able to get out of any situation that we want to get out of when we want to get out of it. So if we calculate these numbers, for example, we get a 1 month expense of $2,350. So what I see when I see this is, all right, if I'm at a job that I hate, or if I'm at a nonprofit, or if I'm working somewhere, or if I want to go travel, take a month off from school or something like that, I really can only afford, if I only have $2,350 in my savings account, I really can only afford to float myself without having a job for 1 month if my savings account balance is $2,350. Similarly, as you keep on saving money and you get up to a point where you can say, all right, I have 6 months, my expenses, now that kind of gives you a little bit more freedom, right? So if your boss calls you at 9 o'clock at night, you can tell them to go explicit. And then you can kind of, leave at your own leisure, right? You're not at the mercy of your employer. You're not at the mercy of anybody or any situation. So this is kind of how I want everybody to get in the scope of thinking about their money, right? How can this money work for me? How can this money provide me the lifestyle that I ultimately want to live? And maybe your emergency fund is going to be 12 months, right? Because maybe it's you and a spouse, or maybe it's 2 years because maybe it's you, your spouse, and 2 kids, right? It really just depends. Maybe you're raising a sibling. Maybe you need to have 5 years for whatever reason, right? This is really up to you. It's just that the minimum that I've seen most financial advisors recommend is 6 months. So just keep that in mind as we're kind of going along. Next is this concept of a debt snowball, right? So let's take, for example, 3 various types of debt, right? We got a regular credit card. Let's say your Chase card, you got a $1,500 balance on it. Maybe you took out a $4,000 personal loan, maybe for a business. Maybe it was, I don't know, to buy some clothes or some shoes or something like that. And then you got a $20,000 car. I think these are fairly realistic numbers, but the concept here is that I wanted you to focus on the size of each one of these individual pieces of debt. And then let's add some additional numbers that we have in our freedom plan, right? So according to my freedom plan, I'm paying $200 per month towards my credit card, $300 per month towards my personal loans, and $400 per month for my $20,000 car. So realistically, it should take me about 8 months to pay off that credit card, right? Now, what most people would do here is they would say, all right, I got an extra $200. Let me go take my wife out to eat. Let me go buy some shoes. Let me go do whatever, right? They got some extra spending money. Instead, at the end of that 8 months, that same 8 months where you're paying that $300 on your personal loans, I'm proposing that you add that $200 to that $300. Because ultimately what's going to happen is it'll only take you 3 more months to be done with both your personal loans and your credit card. So if we take that same concept, and after the 11 months, we were still paying that $400 on the car. We never added any money to that. We take that same concept and add that $500 to that $400. We ultimately will be done paying off that car in a grand total of 28 months. So I know you guys are probably thinking, okay, I mean, it took me 11 months to pay off $4,000. Like, that's not crazy. It took me, 28 months to pay off a $20,000 car. If you would have continued to pay that $300 for that $4,000 loan, you would have been paying for 2 more months and it would have cost you $600. And if you would have continued to pay $400 towards that $20,000 car, you would have been paying for 22 more months, which is almost 2 years, and it would have cost you about $8,800. So this concept of this debt snowball is really about building momentum, right? Once you get through 28 months of just staying disciplined, you can pay off arguably some of the biggest debts that you have, right? And this can also apply to a house. This can also apply to student loans. This can also apply to, other credit cards, things like that, right? the thought here is really kind of not necessarily taking the money that you have now that you paid off with it and start spending it, right? I want you to kind of think about positioning it into other debt that you may have so that you can eventually pay it off. So now that we have our freedom plan, we have our emergency fund, we've gone through this debt snowball idea, right? We want to kind of get an understanding of where we sit financially. So we're going to give ourselves a financial physical. And this is really a very simple formula. Most people have probably seen this before. It's really just your assets, which is, maybe the liquid cash you got in your safe or your savings account. Maybe it's your rental properties. Maybe you got some gold bars. Maybe it's crypto that you got on a USB drive, right? All of your assets that appreciate over time, minus your liabilities, which are going to be things like a car, right? Things that depreciate over time, equals your net worth. And the reason why I think this is important is because I think it kind of gives people a reality check of where they actually sit. For most people, just getting to a positive net worth is a big feat, right? Especially if you have a big, a whole bunch of student loans, or if you got a crazy loan on your house or something like that. This kind of gives you a reality check to say, all right, this is where I'm at currently. And maybe you're doing better than you thought you was, right? So it's a double-edged sword there, but it's good to know your status ultimately so that you can move forward in a way that you think is best. I've done a lot of talking, so I want to propose a question to anybody in the audience. So feel free to get off mute. If you had an extra $200 per month, would you put it towards your emergency fund or your debt snowball? And I can't see who comes off mute, so let me know who you are when you come off mute.
We can do the debt snowball. This is Aaron.
Why you want to do the debt snowball?
That way it'll allow you to ultimately get ready your debt sooner than later. So it's like, yeah, go ahead.
No, go ahead.
No. So I think the concept you was mentioning, the debt snowball, that if you have it and you have like the timeline for everything, it just allows you to drastically cut down some of that debt in expeditiously, and especially some of your larger debt items. I know you mentioned like for a house, for example, something like that. Yeah.
So what if you only have about $1,000 in your savings account?
Meaning, sorry about that. Meaning as far as what?
Meaning in your emergency fund, you only have $1,000 currently.
Do I still want to go to the debt snowball?
Yeah.
I believe so. Maybe I missed that part. I believe so. Yeah.
Okay. All right.
Yeah.
Cool. Appreciate it, Aaron. Anybody else?
How everybody doing? My name is Sam Hunt. I would personally go to my emergency fund.
Okay.
I probably wouldn't put the extra $100 in the debt account just because I would want to try to put as much money away as I can. And, like you said, I think the biggest thing is, if you have an emergency fund, if something drastic happens, you have some money to kind of, use for that. But that would just be my personal preference.
Okay, cool. Thanks, Sam. Anybody else want to go? One more person.
I would do the snowball, just because of if that's a surefire way to reduce my debt, then I'm going to follow that because that's my goal. I want to be debt free. So that's where I would put my money.
Okay, cool. Thank you. So really there's not really a right answer here, right? Because it really just depends on your particular situation, right? If your main goal is to pay off debt, then that's what you can do, right? If you have $1,000 in your emergency fund, maybe you want to build that up so that in the case something does happen, like Sam mentioned, you'll be able to navigate that, right? What if your car breaks down, or What if, you have to pay for an emergency surgery or something like that, right? So those are just things to think about. And I really appreciate how everybody that answered, are thinking about this question, is because this is a real life question. Most people have to make this decision whether they're going to pay off debt or whether they're going to pay off their emergency fund. Now, in this particular situation, I would lean more towards paying off the emergency fund, just because I am also allocating money in my freedom plan towards that debt, right? And if I'm disciplined to pay off that debt as part of my my freedom plan, then naturally I can start to snowball even without this extra $200 a month. But that's like I said, that's my personal preference. So everybody can kind of can start to see how many different ways you can kind of skin this cat. All right, so let's keep moving. So next category is work. And I think a lot of this, some people would have seen before, some of this maybe new to you. But I wanted to provide some context around some of the common things that you see and maybe some of the uncommon things that you'll see. So first, I want to start with this concept of 401k versus Roth, right? I know, at least in my first job, I was kind of struggling between the difference between the two. And I don't think anybody really could really kind of told me in simple or layman terms what the difference between the two was. So let's start with a 401k, for example. So it's really fundamentally a tax-free contribution account, right? And the thing that sets it apart is that it's pre-tax dollars. So the money that's actually going into the account is not taxed. Once it's actually in that account, it does grow tax-free. But once it's time for you to retire at 59 and a half, you do get taxed on the back end of that, right? So there's benefits to doing that. Most companies do have a vesting period, and that vesting period can be anywhere from a year to, I've seen max be about 4 years. Some company will allow you to be vested on day one, which means if you want to leave the next day and you've invested some money into your 401k, you got that money when you leave, right? If you leave, let's say, if they say it's a 4-year vesting period or something dramatic like that, if you leave any time before that, typically it's prorated and you won't get the full amount if there is a company match, for example. The next point is actually a company match. So what that means is companies will actually match you dollar for dollar in some cases, right? So some companies will say, all right, if you put 6% of your salary into the 401k, me as the company will match your 6%. Or some companies will say, all right, well, I'll match up to 50% of what you put in, but you can only put in a max of 6%. So that means the company's only matching 3%, right? And then some companies don't match at all. So really, that's another kind of concept that I think a lot of people don't take advantage of. And we can talk about that a little bit more in a later slide. Lastly, the maximum contributions allowed for 401k currently, it just went up, is $20,500 per year. So I want to kind of give a visual, right, for 401k. So because this is tax-free going in, we like that, right? It's a green check. Once it actually gets into that account, it's still going tax-free. We like that, it's green. But when we pull it out at 59 and a half, it's going to get taxed. So just keep that in mind. On the other hand, the Roth IRA is actually taxed on the way in, right? And everything else outside of that is taxed. Is tax-free. So it does, get funded after tax dollars, like I mentioned before. Once it's actually in that account, it is tax-free. When you pull it out, that's when it's tax-free as well. And then similar to the 401k, it does, there may be some vesting periods, companies may match, but the only difference is the maximum contribution allowed is only $6,000 for the year for Roths. But keep in mind, those are after tax dollars. So similar kind of visual here, right? You're getting taxed on the way in this time. Once it gets there, it's tax-free. And then once you pull it out at 59 and a half, you're good to go, still tax-free. A 403B. Most people haven't heard of this, and that's just simply because typically companies, at least publicly traded or private companies, especially like in the tech, the energy space, healthcare, et cetera, they typically go with either the 401k or the Roth IRA. But this isn't really exactly the same as a 401k, right? The only difference is that the participants for this typically work in one of these 5 fields. So typically they work for maybe schools or colleges or universities, right? Maybe they work for an Indian tribal government or a church or a nonprofit. Ministers and clergy members also apply. So you can kind of think about this the same way, right? It's pre-tax dollars going into an account. It grows tax-free, and then it's getting taxed on the back end for, we'll say, government employees as a generalization. So another pop quiz. Please feel free to get off mute. So if a company matches 6%, what is the minimum amount of money you should invest in your 401k? If a company matches 6%, what is the minimum amount of money you should invest in your 401k?
We're getting 6% or 6% at least in the chat.
Say it one more time, Ayana.
We're getting 6% or 6% at least, or at least 6% in the chat.
Okay, all right, cool. That's correct. So if you invest anything less than 6% and your company is matching 6%, then you're leaving money on the table, right? You're losing free money. All you have to do is provide or invest 6% in your 401k, and you automatically get 6% from your employer. So we don't want to leave no money on the table, right? All right, next question. If a company matches 50% of what you put in up to 60%, what is the minimum amount that you should invest in your 401k? I worded this like this on purpose just to confuse people. So I'm curious if who gets it right.
I see 12% in the chat.
Okay. Anybody else? And feel free to come off mute. You can come off mute as well.
So I'm going to say 6%, but let me make sure that I'm understanding this.
Okay.
So no matter how much you want to allocate to your 401k or your retirement plan, your company is only putting in 50% of that. So they're not matching if you go above 6%. It's only half of whatever you do.
Right. So if you put in 6%, right, they're only going to match half of that. If you put in 10%, they're only going to match half of 6%, right? So regardless, the minimum is you have to put in 6% in order to take advantage of that 3% that the company will be matching. Because we don't want to leave money on the table, even if it is 3%. 3%, over time can make a lot of money for you. All right, last question. If a company matches nothing, they don't give you nothing, what is the minimum amount you should invest in your 401k? Talk to me.
I'm seeing more 6%. Looks like all of these might be between 6 and 12, or just max it out, especially if your company isn't matching.
Okay.
I would say, yeah, whatever you feel comfortable with at that point.
There it is. There it is. Whatever you feel comfortable with, right? If your company isn't matching, you won't leave any money on the table by, deciding to put 3%, 6%, 12%, maxing it out, you're not leaving any money on the table. Some people, and I don't recommend this, but some people say, all right, well, my company's not matching, I'll just invest my own money. And I'll get a better return than my company could have gave me, right? It's really up to your preference at the end of the day. But like Aaron said, right, it's really up to your preference. This is one of those kind of, it could go both ways type questions.
I have a quick question.
Sure.
Would you defer any type of percent until you get your emergency fund up at the 6-month level?
So are you saying don't put anything into your 401k until you get your emergency fund?
Yes.
Okay. That is definitely feasible, right? Because if you're trying to make sure that you have everything in place so that, you have that emergency fund, you have that peace of mind, and then you want to do that and your company's not matching, that's definitely an option, right? So you really just kind of have to evaluate it based off of your current situation. My question to that person would be, though, are you going to be disciplined about it, right? Don't not invest into your 401k and then you're kind of spending that money, that extra money that you'll be getting on other objects, right? Clothes, jewelry, car payment, or other things, right? If you're going to not invest in your 401k, it needs to be going towards something that's either one, going to make you money, or two, going to contribute to your emergency fund. And in some special cases, and I say special cases, very, very, I'll say loosely, debt, paying off some debt, like a medical bill or something that's been, let's say it's been in collections or something like that. I could see that, but I really don't want to get into the habit of not contributing to your 401k and then putting that money towards any and everything. Does that answer your question?
Yes, thank you.
Yep, no problem.
Mm-hmm.
All right, let's keep it moving. So next is RSUs. So I think this is probably the best kept secret for tech companies. And I'll explain why. This is when I first got exposed to RSUs, my mind was just blown. So I'll go ahead and get into what they are and some of the things that are associated with them, and then I'll kind of give you a little bit more context of what I mean. So RSUs are restricted stock units, and they're really just a form of stock-based employee compensation. So typically you'll get these as part of your offer letter, right? Let's say you start a new job at Google tomorrow. Realistically, they're going to give you a specific dollar amount of RSUs, right? And that RSUs can be anywhere from $10,000 worth of RSUs to $500,000, $600,000, $700,000 worth of RSUs, really just depending on where you kind of fall on that, career level and experience line, right? Some people, and I have a couple friends actually that do have, when they signed on the dotted line, they got $250,500 worth of restricted stock units. So this is really a game changer for a lot of people, especially if you don't have an entrepreneurial passion to go out and start your own thing. This kind of gives you the ability to start to own equity without having to do anything but show up. RSUs are restricted during the vesting period, and that may last several years. And during that time, they can't be sold. So what that means is similar to your 401k, a company may say, all right, well, we're going to, these RSUs that we just granted you, let's say $100,000 worth of RSUs. These RSUs that we granted you are going to vest over the course of 4 years, right? So during that time, after each year, you'll get 25%. So if you stay at that company only a year, you'll get $25,000 worth of stock for whatever company you're at. If you stay 2 years, it'd be 50, 3 years, it'd be 75, 4 will be the whole 100, right? But let's say you get to the company, you're like, I don't really want to be here the whole 4 years. I'm just going to get the 25,000 and I'm going to roll to another company that maybe I like better. You will only be able to get that 25,000 and you just kind of leave that 75,000 on the table. So that's just one thing to keep in mind. And if you do decide to leave within that first year, right, you don't get anything. So just keep that in mind when you're signing for RSUs. The only real way to take advantage of the full number, and that can kind of go into your negotiation of how much you're asking for at the end of the day. You know, you want to make sure that however long you plan on staying, you're going to maximize the amount of shares that you're going to get during that time. Units are just like other shares once they vest. So like I said in that example of the 4-year vesting period, after that 1 year, when you have that $25,000 worth of stocks, they're just like any other stock that you would buy in a brokerage account, right? You could sell half of it and maybe buy your kid a car, maybe buy your brother a car, maybe buy you a car, right? And let's say you stayed the whole 4 years, you could easily sell all $100,000 and go buy a house. A lot of people do that, right? So it's just one thing to kind of keep in mind when you're in, especially in tech, it's very heavy in tech. You know, this is part of the total compensation that you get, right? Most people just think about base salary. Most people just think about their bonus. But RSUs really have come into the fold and really made a game changer, or really made total compensation a game changer for a lot of people. So I just wanted to kind of list out a couple of vesting options that I've seen different companies have, and this will vary based off of the company. The first is the 25 per year, right? But then there are also companies that have this kind of ramp up approach, right? So the first year you only get 5%. So they're incentivizing people to stay at the company for as long as possible. The second year you'll get a 15%. You get 15% of your stocks, whatever that amount is. So after 2 years, you only have 20%. Every 6 months, however, after that second year, you'll get another 20%, right? So you'll have 4 more iterations after that second year of 20% until you ultimately get to that 100% RSU. All right, ESPP, Employee Stock Purchase Plan. So this is a company-ran program for employees in which they can purchase company stock at a discounted price. So typically, this is just pulled directly out of your paycheck. So similar to like a 401k, right? If you're at a company like, we'll use Google to stay consistent. If you're at a company like Google and you have the opportunity to buy Google stock at a discounted rate, and it'll come right out of your paycheck, then, you know, if you have faith in the company, you should probably do it. Typically what I've seen is a max around 15%. And so what that means is while everybody else that doesn't work at Google is buying Google at whatever the current stock price is, you'll be able to get it at a 15% discount. So naturally you're making a 15% profit just by buying Google stock every month out of your paycheck. So as long as it doesn't go below the amount you bought it for, you should always be in the green realistically. There is, in some cases, some eligibility requirements for this, and sometimes it's based off of years of service, right? A company may say, all right, we want you to be here for a year before we allow you to, you know, to participate in this stock purchase plan. And then in some cases, you know, if you kind of already are a savvy investor and you maybe own, let's say, a 5% of a company or something like that, realistically, they wouldn't want you to be getting a discount on those shares because you might even be able to take on a minority control or maybe even a majority control of the company, depending on you know, how those shares look. All right. Pop quiz. Can your 9-to-5 job make you a millionaire? I'm curious to see what people think. And why or why not? Can somebody come off mute and talk to me, please?
I say yes, but it may take you 20 and 30 plus years.
Okay. Why do you say 20 and 30 plus years?
If you invest in a 401k in a solid growth company, and not even including other types of stock options or employee stock purchases, you can accumulate $1 million.
Okay.
I used to work for a Fortune 500 company, and I know several employees that after 30 years, they retire with over $1 million in their 401k.
So why do you want to leave out the RSUs and the employee stock purchase plan? Why do you want to leave that out?
I'm not saying to leave it out.
Okay.
That in addition, that would be even more to grow a 401k to become a millionaire.
Okay, cool. Thank you. Who else? What does everybody else think?
I think it depends on your job.
Okay.
Depends on what profession you're in, your job, the career path you chose.
Yeah.
Because you could sign a contract, or your job can say, I want to pay you $2.5 million.
Yeah.
And so automatically, I mean, after tax, you're still a millionaire. So, I think it just depends on your job, your 9 to 5. If not, I do think you still can have a 9 to 5 and make $1 million if you have another stream of income. I don't know if that was part of the question or not, but I do think your 9 to 5 can make you a millionaire just based on what you do.
Okay.
I agree. I want to say I want that 9 to 5 that is paying 2.5.
You know what I mean?
Most definitely.
But I think that you can be a millionaire from a 9 to 5 without having to wait for the 20 to 25 years of investing in your 401k or with your stock options. I think, as Sam said, depending on what company, what industry you're in, especially in tech now, if you're working for the Googles, you're working for the Microsofts, the Metas, some of the stock options that they're giving are up to $250,000 upon being vested. And so as those companies continue to grow, you could easily become a millionaire just off of your stock options within 2 to 3 years.
Yep. 1000% correct. And that's kind of what I want you guys to start thinking about, right? And the reason why I keep picking on tech is because I feel like tech is kind of on the bleeding edge of this, right? I feel like we'll say older industries, right? Like energy, or we'll say slower moving industries like energy, maybe, government, maybe healthcare. I will say that they're not as on the bleeding edge of this, not to say they don't have RSUs, but I think it's a lot more common to expect something like $100,000 RSUs from a company like a Google or a Microsoft or an Amazon than it would be from a company that like an ABB or a GE or something like that. So that's why I posed the question. So I appreciate you guys' feedback on that. All right, family. The good and the bad. I'm just kidding. So let's start with the 529 plan. I feel like a lot of people may know what this is, but just kind of want to provide a little bit more insight because there have been some changes since I think 2019 on this plan. So a 529 plan is an investment account that offers tax benefits when used to pay for qualified education expenses for a designated beneficiary. So if you notice, I think most people think of a 529 plan as something that they get for their child, right? And that definitely is something that you get for your child. But because it uses the wording designated beneficiary, I want you to kind of broaden that, right? So if you have a younger brother that maybe is in middle school or something like that, you can actually open up a 529 plan for them. If you have a nephew or a godson, right, you can actually open up a 529 plan for them and receive some tax benefits for doing that. The only thing to keep in mind is that it has to be for a qualified education expense. And I'll list some of those in a few minutes here. One thing also to keep in mind is that any money that you put into this 529 plan is going to impact any financial aid that they apply for when they actually go to school. So if this is something that you've been doing consistently, maybe since they were a baby or maybe since they were in elementary school or middle school, maybe this won't be an issue. But if you are planning on have them actually actually apply for financial aid, this is one thing to keep in mind for this. So here are a list of some of the qualified education expenses that will qualify under the new 529 plan. Excuse me. College and tuition, of course, was on there previously. For the vocational trade schools, tuition. So if your child wants to be, let's say, a chef, right? Now that's covered. I don't think originally it was covered under the plan. I think you just had to go to a 4-year or 2-year university or grad school. Now it does include those vocational and trade school tuition and fees. According to the Tax Cuts and Jobs Act, the elementary and secondary school tuition is covered up to $10,000 per student at public, private, or religious elementary or secondary schools. Student loans are covered, but only up to a lifetime limit of $10,000 that can be used from your 529 plan. Off-campus housing is also covered under this plan. The only caveat is that the off-campus housing and rentals are qualified only up to the cost of the room and board on that campus. So if the cost of room and board on campus is $800, it'll only cover $800 of the off-campus housing. So if you got $1,500, then you got to cover the other $700. I think the rest, books, supplies, computers, computer software, internet services, special needs, equipment, I think all of those are self-explanatory. Some business purposes, I think you're gonna have to do a little bit more research on kind of how that fits within your specific situation. So if you have any questions about that, I would definitely spend some time looking that up just to make sure you have a full understanding of what qualifies and what doesn't. But that's a 529 plan. The next account is a custodial account. And I don't think too many people have heard about this account. It operates similar to a 529 account, except it's not limited to educational expenses. So the term custodial account generally refers to a savings account at a financial institution, mutual fund company, or brokerage that an adult controls for a minor. And that minor could be up to the age of 18, or it could be up to the age of 21, depending on the laws of each state. So approval from this custodian, in this case, the adult is the custodian, is mandatory for the account to conduct any transactions. So that just means the kid can't go in and buy stocks or sell stocks or buy bonds and sell bonds. Kid can't do that without the adult knowing. This does have a lot more flexibility than a 529 plan, like I said, because it's not limited to just education. You can pretty much use it for whatever you want, right? There's no income restrictions, no contribution restrictions, or withdrawal penalties. Really, this is something that would be used if, let's say, you knew your kid wasn't going to go to school. Maybe they just wanted to use this as their business loan. Maybe they want to use it for a wedding or to buy a house. This would be more applicable to for your kid. Gifts to the custodial account. This is an important point, right? What this last statement is saying is, once, if I have 2 kids, we'll say Bill and Jill, if I put Bill on a custodial account as a beneficiary, I cannot go back and then change it to Jill. I cannot add you. I cannot adjust the beneficiary at all. Additionally, if I have put $10,000 up until this point into that custodial account for Bill, I can't take that money out because legally that account is owned by the minor and I'm just managing it for that minor. So that's one thing to keep in mind with a custodial account. Once you do it, it's kind of set in stone. There's two types of custodial accounts. The first is this UGMA, and that is your traditional financial instruments like stocks, bonds, mutual funds, index funds, cash, and insurance policies. This is the original custodial fund. And since they've added an additional one, which is the UTMA, which includes everything that's in the previous UGMA, plus any physical assets such as real estate, fine art, or anything like that, like gold. So this, I think that if you're going to go with the custodial account, the UTMA does give you that added flexibility if you do have rental properties, if you do collect art, if you have maybe some gold bars laying around or something like that. The UTMA does give you a little bit more flexibility. One other caveat that I want to add for the custodial account is that there aren't any tax benefits to having a custodial account like there are the 529 plan. So just keep that in mind when you're deciding between the two. All right, another pop quiz. In your personal opinion, which one would you choose? And if you don't have a child, that's fine. Which one would you choose for a younger brother, a godson, a nephew? Which one would you choose based off of the information that you just saw in the 529 versus the custodial account?
We've got a vote for the 529 in the chat. My question is, could you do both?
You can do both. You can do both.
Yeah, I was gonna say I'd go with the 529. It sounded, I like the aspect of the tax benefits. And then it just sounded a little bit, maybe I liked the description of it better, but I like that one.
Yeah, the only thing is if you know your kid gets older and they're like, man, I don't want to go to school. I don't want to go to vocational, whatever. And money can only be used really for education expenses. So you're either gonna drag them to school or you know. So that's just one thing to keep in mind.
I have a question regarding that 529.
Sure.
Can those funds be used for your own like educational experiences for maybe like future grad school or going back to school? Since that kind of falls in line.
Yeah, it can actually. So if you decide you want to go back to school or something like that, it does allow you to use that expense for that, right? So yeah.
So that could be a savings vehicle for someone who's planning, who's maybe not able to go to school back right now, but in the future they have potential goals. Okay, didn't know that.
Yeah. All right, let's keep moving. Joint brokerage account. So I know most people have heard of a joint savings account, especially if you're married. But a joint brokerage account is owned by two or more individuals. And most people think about, all right, well, I can open up this joint brokerage account, you know, just with my spouse, but you can open it up with a parent, you can open it up with a child, you can open it up with a business partner, right? If you and your friends want to start a investment account, y'all all put money every month and you want to invest in some stocks, do some options or something like that, this is the place to do it, or one of the places to do it. So yeah. One thing to keep in mind is that both parties do have equal access to access the account. So don't put anybody on this account that you think is going to steal money from you, because they will be able to steal it and there won't be anything that you'll be able to do because they have full access. So let's keep that in mind. The last point is, I know, at least I have stories, I've heard plenty of stories of grandparents passing away and you not being able to, you didn't know about a specific bank account that they had or an insurance policy, or parents passing away and you're not knowing about a particular bank account that they had, right? This does give you the access to a joint account, right, in the case of hardship, because both of you have that access. So that is a positive thing about this brokerage account. You both are on the same investment account. All right, I think this is probably the section that everybody has been waiting for, the individual section. And this is really going to be focused around kind of getting started at a high level with your investment journey. So to start, I want to start with some definitions, because I feel like I want everybody to level set, be on the same, level. Some people may know what stocks are, some people may not know what stocks are. So a stock is a security that represents the ownership of a fraction of a company. This entitles the owner of the stock to a proportion of the company's assets and profits equal to how much stock they own. Units of stock are called shares, right? So when you think of a stock, you almost think of it as being synonymous with a company, right? So the Nikes of the world, the Apples of the world, the Teslas of the world, right? So if I say, hey, I just bought some stock, typically I'll say I bought some stock in a Nike, right? So that's how I want you guys to think about it, right? You'll typically hear people also say, I bought X amount of shares of stock in Nike, right? Shares are kind of the unit, the subunit under a stock, right? So if I buy 5 shares of Nike, that just means I bought 5 shares of stock in Nike. It's the same thing. So just want to kind of level set with stock. The second definition is mutual fund. So you can think of a mutual fund as a financial vehicle made up of a pool of money collected from many investors to invest in those stocks, those bonds, money markets, and other assets, right? So let's take those 3 stocks that we had originally, let's put it in a basket. That's a mutual fund. But what makes a mutual fund different is that this mutual fund in this basket, you're actually paying somebody to manage it for you, right? You're paying somebody to be able to take out a Nike and put Adidas in where Nike isn't doing so well, right? So typically what happens is with mutual funds, they have higher fees because it's actively managed, right? And then they'll have investment minimums because it's a pool of investors doing it, right? So you may, for this particular mutual fund, you may have to pay upfront $2,500 just to buy into the mutual fund. So keep that in mind. ETFs, similar to mutual funds, are a pool of money, right? You can think of this basket. I want you to think of this basket. And ETFs will track a particular index, a sector, a commodity, or asset. But unlike mutual funds, you can exchange and purchase. You can purchase or sell on the exchange the same way that you can a regular stock. So one thing I didn't mention with a mutual fund is that the only time you can actually buy a mutual fund is at the end of the day. Only time you can buy and sell is at the end of the day. So let's take, for example, Google, right? I love Google. It starts out low and it goes up at 12 o'clock in the middle of the day. And then at 1 o'clock, it just tanks and goes negative. And so at the end of the day, Google is negative, right? The only time you can buy that mutual fund that includes Google, maybe it's heavily weighted in Google, the time you can buy it is at the end of the day. So just keep that in mind, right? ETFs, on the other hand, you can buy throughout the day. If you see that it's at a low in the morning, you can buy it right then, and then you can ride that wave back up, depending on how good your ETF is in that case.
Quick question, Justin.
Yep.
Can we go back and maybe talk about the difference between the mutual fund and the ETF? I think we had some questions about mutual fund definition.
Okay, yeah, so sure. So I want you to think about an ETF as I think everybody's been to Sam's, and they have those assortment of chips, right? And each of those chips are stocks, right? So they all sit in this box. You go buy this box, and the ETF, you go buy the box yourself. A mutual fund, on the other hand, the only difference would be you paying somebody to go get that box for you. So they're both still, you're both still getting that assortment of chips, right, or stocks. It's just you're paying a little bit more to have it actively managed, to have somebody go in the grocery store, pick it up, and maybe deliver it to you and give it to you all nicely, right? And you don't have to think about it as much. Whereas an ETF, you're actually buying it like a regular stock. It's still a basket, but you're actually going into the store and getting it and buying it yourself. Does that make sense?
Got it. Perfect.
Okay. All right. So I want to give my little basket analogy some shine here. So yeah, like I said, same concept. It's still a basket, and it can include these stocks, all these different stocks, and it doesn't have to be Apple, Tesla, Nike. Typically is, maybe 50, maybe 100 companies in this, and they each have a different weighting. So maybe Tesla is weighted at 5%, Apple is weighted at 2%, Nike is rated at 0.5%, right? And it kind of goes down from there. So you'll have your ETFs or your mutual funds be, we'll say, heavily weighted. We'll say like a max around 6 to 10% in one particular company, and then it'll go down and weight per the company as it goes down the list of companies in that basket.
So in either ETF or mutual, well, let's stick with mutual. So do you have control of the variety of chips in the basket in either one of those?
Right. So that's something that you have to come up with before you actually buy, right? So what you can do, and there's a website that I can send out, it's called etfdb.com, and I can put that in the chat. But essentially what it does is, essentially what it does is it allows you to search ETFs. And so if anybody gets a moment, you can search VOO, that's a ticker. VOO, that's a Vanguard ETF. And once you search it, you can go to holdings. And actually, I'll just share my screen so that everybody isn't going crazy looking at it. Give me 1 second. Here we go. Can everybody see my screen?
All good.
Okay. All right. So VOO is actually a Vanguard Sp 500 ETF. And as you can see, these are the top 15 holdings in there. And it has a percentage of weighting here. So if I know that I really love Apple as a company, Microsoft as a company, Amazon as a company, and Tesla, right? And it weighs this percentage, and I don't really care what ExxonMobil is doing because it's way more heavily towards this. So the performance of this might drive me to want to, buy this one versus another one, right? And you can just, once you kind of get accustomed to each of these tickers, so like BTO, for instance, is another Vanguard ETF. It searches. Let's look at VTI. So VTI is another one, and you can actually click the holdings to see what the top ones are, and you can actually see what each of the percentages are here for each of these companies. So maybe you didn't like ExxonMobil, you thought it was too high up on the list to be in the top 15. Maybe you like VTI more. So maybe you decide you just want to buy stock buy shares of this ETF. I hope that helps. So I'm going to stop share again, and I'm going to go back to my presentation. Okay. Did I answer your question, Iana?
Yes, sure did. Thank you.
Good. Okay. All right, can you see my slide deck again?
Yes.
All right. All right, so index. An index measures the performance, the price performance of a basket of securities using a standardized metric and methodology. So typically what most people think of when they think of the index is the S&P 500. And rightfully so, because most people, especially like professionals on Wall Street, they use the S&P 500 as a benchmark to say, all right, the economy is doing well, or the stock market is doing well because we are outperforming the S&P, or we're on par with the S&P, right? But they also use it as a way to see, all right, am I underperforming the S&P, right? So you think of it, you can really think of an index as like the benchmark for a particular area. So in this particular case, the S&P 500 consists of the leading, put it leading because that's very subjective, 500 companies in the United States. And that's why they use it as a benchmark, because it kind of gives you a broad perspective of 500 companies. And you can use that as a gauge to see if you're outperforming, even in your personal portfolio, and stock portfolio. You can use that to see if you're overperforming or underperforming. Just in case that wasn't, a clear example or clear as mud, I know people have probably, especially since COVID started happening, have been talking about the cost of lumber, right? What does that actually mean, right? Lumber prices are rising. They're using an index to determine if the price is rising, right? They're using a benchmark to say, all right, lumber is rising. Similarly for gold, right? Whenever you hear gold prices are going up or gold prices are going down, they're looking at an index to use as a benchmark. So when you hear index, and you may see like the NASDAQ or the Dow Jones, like all those are indexes, and they're just benchmarks of how a specific set of companies or commodities like gold and lumber or corn are doing over a extended period of time. Last definition is an index fund. So it's exactly what it sounds like. An index fund is a type of mutual fund or ETF with a portfolio constructed to match or track a financial market index, like the S&P 500, for example. So if, let's say, for instance, you decided, you know what, Justin, I don't want to invest in single stocks just because it's too risky. I don't want to invest in, any particular area, like sector or anything like that. Like, I really just want to invest in the S&P 500 because I know traditionally it is always going up. It may come back a little bit, but traditionally it's always gone up over an extended amount of time. You would invest in an index fund that tracked that S&P 500. And you can always search what those, like which ETF works better, and you can compare it to other ETFs using this ETFDB, ETFDB.com. VTI, for example, is an index for the total stock market, right? VOO, the one that I looked at before, that was an index fund that tracked the S&P 500. So just keep that in mind. If you just want to, kind of be on the safe side, you want to limit your risk, investing in the S&P 500 through something like a VOO is a really good choice. And it's something that people like Warren Buffett, for example, have been preaching for the longest amount of time. So just to kind of give you guys some visuals, each basket will have its own index here, right? So like you're not going to have gold and S&P and lumber all in the same basket. Each of these pictures, each of these baskets are its own index fund. They track their own index. All right, so let's get started. All right, I know there was a lot of definitions. I want to go ahead and get started. So Really the biggest thing, I think the biggest hurdle for most people with investing is actually just opening up the account. And most people don't realize opening up an account really only takes like 5, maybe 10 minutes. You put in all your information and they need your social and stuff like that, and you just link your bank account. So even if you're not planning to invest until maybe 6 months from now, right? It doesn't hurt anything just to go ahead and open up a brokerage account and have that sitting there so that once you actually are ready to invest, you got your money in your account, in your bank account, you can just go in and hit the transfer button and that money transfers within 1 to 2 business days. So I want to talk about a couple different brokerage accounts that I personally recommend. The first is Fidelity. And that's really just because I think for beginners, right, that want to build wealth, that want to generate a lot of money over time, it gives you, number one, the reliability, it has the credibility, and also it gives you a really good platform so that you can learn about stocks, you can read analyst reports from people on Wall Street. You pretty much can get any piece of information that you'll want to get from this platform. Secondly is TD Ameritrade. I'm not sure if anybody's seen like the Thinkorswim commercials, or if people have used Thinkorswim, or maybe you have a 401k that goes through, or Roth that goes through Ameritrade. But Ameritrade's user interface is probably the best that I've seen personally. And it's one of those things where even if you don't know what you're doing, if you're on TD Ameritrade and somebody beside you has never seen a stock chart or anything like that before, you're automatically going to look like a genius. So just keep that in mind. Next is Vanguard. And Vanguard, and I have to fact check myself, but I believe Vanguard may be the oldest brokerage account. So they definitely have the track record. They definitely have the reliability there, right? And really the theme here with each of these three is that they will allow you to establish a significant amount of wealth while also providing you resources to kind of learn as you go, right? You might get halfway through your journey and realize that you want to change your strategy up. And they provide resources that'll help you be able to get to that point. The last two I want to talk about are newer, and they're Cash App and Robinhood, right? And the reason why I want to talk about these is because I think, especially in the Black community as of late, with us being in the house with COVID, these two platforms provided us the most accessibility, the fastest, right? We're all sending cash through Cash App, and even now you can actually send stocks through Cash App, right? So I can send my friend a share of Apple if I wanted to through Cash App. So this kind of gives you that easy accessibility to something that I think, at least for me growing up, seems way far off from where I was actually at and even ready to go. And similarly with Robinhood kind of gave a lot of people a lot of access, especially like when the meme stocks started going up and GameStop started running up significantly. Robinhood kind of gave people an easy way to get in on the action, for better or for worse. But I think a lot of people migrated to these two platforms because they made it so simple to get started, right? My only caveat with these two is that when you're talking about building wealth, I don't know that they have the track record right now to support you when you get to the millions, the 2 millions, and hopefully billions of dollars that you guys are going to have in your brokerage accounts. All right, next is establishing your goals. So I broke it into two sets of goals, short-term and long-term. And I tried to frame these into questions that you should ask yourself, right? The first question is, how much money am I willing to invest every month, right? And I want you to be realistic with this question. Don't say, I'm going to invest $1,000 every month if realistically you can only invest $600, because we want you to stick to this, because compound interest is going to be the thing that carries you the most throughout your wealth building journey. And so if you realistically can only invest $600, invest $600. If you can only invest $20, invest $20. I promise you it will be better than you skipping a month here and skipping a month there. Compound interest is ultimately going to take off at some point anyways. So you want to make sure that you're investing consistently in the stock market every single month once you're ready to get started. Second is, how often do I want to look at the market? The reason why I pose this question is it's going to really be a major factor in how you build your strategy, right? Are you going to be the person that only wants to look at it when their money gets transferred once or twice a month? Or are you going to be the person that's going to be looking at the market every day, right? When I first started in the market, I was looking at it every single day. Like, if Apple moved even a 0.5%, I knew Apple was moving a 0.5%. I had the app, the widgets and stuff on my phone. Like, I was honestly obsessed with the stock market for a while, and to the point now where I don't look at it as frequently. But that's one of those things that you have to take into consideration, because if you're going to be investing in more risky or volatile stocks, right? If you're only going to look at it twice a month and it hits a deep drop one day that you're not looking at it, it's going to end bad. You know what I mean? So just keep that in mind. And second is establishing what your risk tolerance is on a scale of 1 to 10. 1 being, I'm cool with risk, 10 being absolutely not, I can't do it. Because this is really going to determine how you go about building up what companies, what industries you want to focus on. And that brings me to my last short-term question, and that is, what industries and companies do you want to focus on? So I know, people work in healthcare, they're like, oh, I know healthcare, I'm going to invest in healthcare. People work in tech, they're like, oh, I know tech, I'm going to invest in tech. But what you'll find, especially when you're doing research and stuff, is that there's a lot of opportunities in industries that you wouldn't have otherwise thought about, right? Growing up, and I know I have some gamers on, growing up, I would have never thought about an AMD chip or an NVIDIA chip, right? But since COVID happened and, they had the semiconductor shortage, semiconductors actually became a really great market for people to look at and for people to invest in. And people made a lot of money, especially after the NVIDIA stock split. People made a lot of money in NVIDIA. And unless, that was something that you were privy to, you would have never even, had any thoughts about it, right? Or unless, you were a gamer, or unless you built computers for a living and you just knew what a graphic chip was, right? So just keep those things in mind. Be open to looking at other industries and other companies that you wouldn't have otherwise considered. The second long-term thing, and I know I gave you 4 long terms, but I want to give you 1 short term, and this was a good one. If you can only live off of 4% of the total amount of money in your brokerage account, how much money would it take for you to be able to live a comfortable lifestyle? So let's use some easy numbers here, right? Let's say I have $5 million in my brokerage account by the time I'm 65. If I live off of 4% of that from starting the time I'm 65, I live off 4% per year. That's around $200,000 per year. If I live off of $200 per year, realistically, I'll be able to live off that money for 25 years after that point, right? If 25 years is enough, by all means, go for it. And you could easily adjust this down to 3% or 2% or 1% year to year. But I want you to kind of think about what that end number is and kind of work backwards so you can see how much time, right? If you want to retire early, then maybe you need to have a little bit more than that in there so that you can so your money can last for a little bit longer, right? Maybe you don't need to live off the whole 4% if you got 5 million there. Maybe you only need to live off of 1%. That's fine too. It's really going to be based off of your current situation. If your house is paid off, maybe you can only live off 1%. Maybe you only have to live off 1%. The car is paid off, similar things. So just keep that in mind. Next is strategize. So I want you to really think about, and this is a good one, where you're going to get this information from. So for beginners, I think it's important for you to kind of block out as much noise as possible, just because, especially, since the pandemic hit, there are a lot of financial experts out there. There are a lot of people saying, hey, I can help you get to $1 million in 2 months. There are people that are saying, hey, I can help you get to 6 figures in 2 months. There's a lot of people saying a lot of things, and it's a lot of noise. what I would recommend for you is if you have the opportunity during the day, during market hours, which are 9:30 to 4 o'clock, to just turn on CNBC, right, and just listen. You're inevitably going to pick up something, right? You're going to get some knowledge about a particular industry that you wouldn't have thought about. You're going to get some knowledge on a particular stock you wouldn't have thought about. Maybe something will come across the bottom of the screen that you didn't think about, right? So if you do have the opportunity to do that, I do recommend that. If you don't have the opportunity to do that during the day, there is a show on CNBC as well that starts at 6 o'clock. It's called Mad Money with Jim Cramer. That really kind of gives you a rapid fire of a lot of different companies and his perspective on those companies. And it's good for a beginner to see that because it may come off as overwhelming at first, but ultimately you'll get to a point where you'll start to kind of remember some names or remember you saw something in the news about this particular company and you want to look a little bit further into it, right? So that's also a good thing. Some of the simple things you can do is, do things like turn on your Apple News app, filter it for finance. If you want to get the Wall Street Journal or the Financial Times, you can do that as well. Those are some simple options that you can do to get some information. The second is decide whether or not you want to invest in a single company or a group of companies. I typically will recommend, if you do decide to do the group of companies, to err on the side of the ETFs, just because it's, you don't have to worry about fees. You don't have to worry about minimums. You can invest $5 in the ETF if you want to. And I think we all on the call have $5 to spare towards an ETF. And if you feel more comfortable and you feel like a company is going to be around for a really long time, invest in some single companies, right? We all use Apple products, probably. We all use Google products, maybe. We all use Windows products, right? So companies like that you think will be around for a long time, maybe it is worth it to invest in a single company. Third is, what company or ETF do I want to be my foundation? So this is really a question that I posed to myself when I was getting started, because I wanted to make sure that if everything went to red, I had a solid base that I can build off of. So what this looks like is imagine you have a table and your ETF or company single stock is your table, right? And every other stock that you buy after that is stacked on top of that table, right? If all these stocks end up falling off the table and going red, you still have your table, right? You're still making money off your table every month. So that's the kind of approach that I want you guys to think about when you're starting your investment journey, right? What's going to be my foundation, and then build off of that foundation to your ultimate goal. And then lastly, you really don't need a lot of stocks or ETFs to make money, to build wealth, right? I personally recommend establishing just a top 3. But if you do find some instances where you want to add in, a couple extra stocks that you really, really like, make sure that I would say do a max of a starting 5. So just keep that in mind. Next, let's just go for it, man. Let's just go for it. Let's jump in. We all want to have the money Jay-Z and Beyonce do. And like my brother-in-law says, scared money don't make no money, right? So you got to jump in. The sooner you get started, the more you'll have in the long run. So I know I've been talking for a while again, so I want to do another pop quiz to get you guys back active. What, in your opinion, do you think the most important element of investing is?
I would say one of the most important elements of investing. So are you talking about like far as what you said?
It doesn't have to be what I said. It could just be your opinion. Like, what do you think the most important element of investing is?
I would say, honestly, for me, like, I've been like investing in like doing like just regular investing in like trading options as well for like a few, like I'll say 2-3 years now. And honestly, I would say the number one most important thing is like not making emotional decisions. Like if you notice a certain stock or something like that, like just don't react out of emotion, basically, because you can lose some money when you like act out of emotions.
You can
So
lose a lot of money.
That's number one thing.
Yeah, you can lose a lot of money acting off emotion. Okay. Thank you, Rich. Anybody else?
I think you have to know your risk tolerance and really be true to yourself on that. And a lot of that may change depending on your age. As you get older, of course, you want to maybe be less risky.
Mm-hmm. Absolutely, absolutely. Your risk tolerance as well. You need to make sure you keep that in mind. Anybody else?
I would say.
Like we have. Go ahead.
Go ahead.
Oh no, I would say just starting, like to the point of your last slide, just jumping in. I think, you know, with all the terms and everything, it could be overwhelming to say, like, you know, where do I start? Where do I start with? You know, what company? And I think, you know, to your point is maybe finding something that you believe in and just get acclimated with it, you know, just kind of, you know, just start the process.
Okay. Thanks, Aaron. What, Ayana, were you about to say something?
Yeah, it looks like we had a couple people say like patience, but also like getting started as early as possible, which is also something that we saw in the chat too, is wondering like, how do we get our kids, our younger brothers and sisters, just younger people started with investing? Like, what are some options there? What are some suggestions that you have for that as well?
Yeah, sure. So I do want to table that question for the Q&A so that we can get through, but I'll take note of that, and please ask that question again once we get to the Q&A. Sherman, did you have one thing that you wanted to say?
Yeah, well, I just put it in the chat.
Okay.
And I was thinking about diversification
Okay.
to some degree, and we can wait until it may come up in the Q&A.
Okay. All right, cool. So all of these are really good. And I'm really glad that you guys are thinking about it this way. But I do want to say, regardless of, you know, options, regardless of stocks, regardless of ETF, what you're investing in, right? The most important element is time. Because time is kind of that common factor that you have to consider, right? I think it was Roxanne that mentioned, you know, as you kind of get older, you kind of have to look at your risk tolerance, right? Well, the thing that you're kind of gauging there is the time, how much time you have left, right? With options, the key thing is your expiration date, right? You need to get those options either sold or you need to sell, you know, buy them before that expiration date, right? So time is really going to be key here with getting started, and that's really what I want to drive home, is because the earlier you start with investing, the more benefit you'll see from that compound interest. And so keep time first and foremost. So if you're, you know, on the fence about investing, you're on the fence about opening up that brokerage account and just getting started, even if it's $5, it's $10, like I promise you, you're doing better than, I'll say, about 50% of people just opening up your brokerage account. So I would challenge everybody, you know, if you have time when you get off a call, maybe it's tomorrow sometime during lunch break, just make your brokerage account. And you may not ever use it, but you made it, you know what I mean? So let's keep that in mind. So now we're gonna go into the pro tips. First pro tip, never buy a stock at its all-time high or close to it. So this is Microsoft. Microsoft is a great company. This was November 22nd, right before Thanksgiving, 2021. It was close to its all-time high. Well, not close to its all-time high, close to its 52-week high. And for those who've never seen a stock chart, this is what a stock chart looks like, or one way a stock chart looks. So yeah, never buy it at the high. Continuing on that trend, right? All stocks pull back at some point in time. I don't care how good the company is, all stocks pull back. So can you imagine if you would have bought at that high of around $350 per share, right? It ultimately fell back down to $283. So if you would have bought at $350, you would probably be sick and you'd probably be like, well, look, I'm never investing in the stock market again, especially if this was your first time. So just keep that in mind, you know, when you're investing. And I'll give you a good indicator to where you don't have to look at these charts to be able to see if it's a good time to buy or not. So don't feel like you got to know what charts are saying for you to be investing. Pro tip number 3, please don't believe everything you hear or see on social media. Social media, I joke with my friends, social media is the matrix. People take pictures of themselves when they are their happiest, not when they are their saddest, right? They are a lot of financial gurus on social media. And I'm not saying that there aren't any good ones. There are a couple really good ones, but I'm not going to sit here and tell you that you need to just kind of go out and listen to everybody that's selling a course on social media. So please keep that in mind. I promise you the research that you start doing and once you start making money, ultimately will benefit you more in the long run than going on social media and listening to the majority of people that will be providing advice. Pro tip number 4, buy great companies when everyone else is scared to. So this thing right here on the right is called the Fear and Greed Index. And what it does is it gives your market sentiment or how people are feeling about the stock market. And I'm going to put this in the chat, put a link to this in the chat. This basically will tell you if people are scared about what the market is doing, or if people are being very greedy and buying a lot, right? So this is a good indicator for you to just Google and say, all right, let me see what's going on in the stock market. This is something that you can go and look at and get a good idea of whether or not what something is doing in the stock market. All right. Pro tip number 5 is sponsored by Money Mayweather himself. Not really, but buying and holding is the best way to build wealth in the stock market. All of the billionaires, the investor greats, all hedge funds managers, all of them, they all recommend buying and holding. And it's really based off of the commonality of compound interest. Compound interest is really going to be the thing that kind of takes you to that next level. So with that, I do want to share a couple helpful links in the chat, in the slide. So the first 2 are links to open up your brokerage account. And you could decide if you don't want to use Fidelity or TD Ameritrade, you want to use Cash App, that's fine. You want to use Robinhood, that's fine. Just open one, right? The third one is Investopedia. This is going to be your dictionary for any financial term you're going to want to look up. If you get off this call and say, Justin, I don't really know how I feel about the definition that you gave me for a mutual fund. I want to go look this up. You can look it up here. And you should realistically be able to get a good idea of what to expect. The fourth thing is a compound interest calculator. I know I talked a lot about this, but this is a financial tool that a lot of people use to get a good idea of how long is it going to take me to get to that $5 million, right? How much do I have to invest per month, right? What percent return do I need to get every year for me to get to my ultimate financial goal? This is a calculator that'll help you get to that point. And because, a lot of people want to kind of jump in at this point, Yahoo Finance is a good first step for you to kind of get a good idea of all the financial news that's going on, any updates. Elon Musk just bought Twitter, right? That would have been on Yahoo Finance. This really gives you a really good first pass at a lot of the financial news that may come up in the news. So before I get off, before I go to the Q&A, I do want to add a survey to the actual chat, and you can kind of feel free to take that at your leisure while we're doing the Q&A, but I wanted to go ahead and add that in there just in case people want to go ahead and take it. And then we could go into our Q&A. So I'll stop sharing and we can start talking about some of the things that I talked about, some of the things that I didn't talk about. And yeah, feel free to either jump on camera or pop something in the chat. I'll try to find questions in the chat. If I don't get to your question, or if you just want to come off and ask it again, that's fine. But yeah, the floor is open.
Yeah, I have a question, Justin.
Yep.
I guess like for someone that's like just beginning to start invest, like what would be the best ways that you would say that they can like practice having patience? Because like you tell someone to have patience, but especially like if they're just like starting investing and they see they might be losing money or it might be down, like what would you say is the best ways that you can like put those that patience in? Like,
yeah, that's a good question. So I don't think there's a best way to do this. I think you should start small. I think that's realistically going to be, because to me it's like, all right, you put $100 in the stock market and you lose, $20, you're going to be upset. And the more your dollar amount goes up, right, you're going to be more upset, right? So I just say start small. Keep the end goal in mind, and really try to put some guardrails on yourself, right? Like say, all right, I'm going to invest this money and I'm not going to look at it for the rest of the week. And if you're doing your research up front, then realistically, you should have that peace of mind anyway, right? You shouldn't have a need to invest and consistently be looking at it, because you invested in good companies. You have your solid foundation, right? Everything is going to go down initially when you put your money in. That's just how it goes. As soon as it goes in, it's going to go down initially. But if you're invested in good companies, the thought is that it's going to go up in the long run. All right, anybody else?
Hello, Justin.
Hey,
Thanks for a great presentation. And I just wanted to ask, I have a few questions, so I'll ask them spread out, let other people go. But my first question is something I've been kind of thinking about is, so there's, for example, like Berkshire Hathaway, obviously that's like owned by one of the wealthiest people in the world. But could an average Joe like myself take that approach and start a company and own and essentially buy stock under my company or
Yeah.
LLC?
Yeah, you could. So one tip and trick that a lot of small businesses don't know is that you actually can have a portion of your business invested in companies, right? Like, think about it. Amazon invests in small companies all the time, and they're Amazon, right? They're invested in Databricks. I'm not sure if anybody knows what Databricks is, but they're invested in Databricks. So, companies do it all the time. It's just us as, I don't want to, put a caveat on African Americans, but like we just were late to the game. You know what I mean? But all of that stuff people have been doing for years. Like, people have LLCs and they're invested in the stock market through their LLCs, right? So that's something to think about as well. If you have a business, or if you want to open up a business, you can invest through your business.
Thanks.
Yep. I see are there fees associated with brokerage accounts? No, there aren't any fees to open up a brokerage account. Once you get in a brokerage account and you want to, buy a mutual fund, for instance, there's fees associated with that mutual fund. There might be fees associated with something that you try to buy, right? But there's not a fee to open up the brokerage account. Elliot, go ahead, ask your other questions.
Okay. I think what was one I Oh, I've heard at first I was confused when one of my coworkers he was like, my mom told me to max out my 401k. And so at first I was like, man, I was like, how much money does he make that he can like put, his entire salary into like, his 401k. And so now like from your presentation, I think I understand better. And so I just wanted to like ask if you could clarify, or not clarify, but for me, it's maxing out that 20,500.
Yeah, so typically when you're at a company, they'll have a percentage amount, right? When you're at your company. So that's where the 6% come into play. That's where the 3% come into play, right? I want to say the max percent that you can invest is, don't quote me on this, I gotta look it up because I forget from time to time. I think it's 12, it's either 12, somewhere between 12 and 18%. I have to double check though, so don't quote me on that one. I'll double check, but yes, that if you look up on SEC or the IRS website, that the total amount is that 20,500. So if you make over a certain amount, right, and you maxed out your account, they're going to stop it after a certain point, or you'll hit some penalties or something.
Oh, cool, thanks. And I guess one of my other questions was this one's kind of, well, I'll let you like, so recently with like, so I think everybody remembers like a year ago, it was essentially, I guess you could say around March 2020 was when stocks went down because of the coronavirus. So I thought it was ironic that a year later you have essentially, in the same time period. And so I was just wondering if you could shine some advice on, say, I felt like when it was the pandemic, I remember seeing like Chipotle, for example, and I haven't been investing for a long time. So that's why it's like I remember it's because it dropped to like $500 or something. And I was like, oh, that's interesting. And like a lot of stocks were dropping almost to like 50% of their value. How do you know when to I guess take that risk and get in versus you wait and then one day everything shoots up and then you're like, oh, I waited too long.
Yeah, so it's hard to pinpoint the actual day, right? But there are charts, there are seasonality charts, right? Like let's take for example, Amazon is going to most likely go up during Christmas time, Black Friday time, just because the volume of people buying their products is up significantly during that time. So they typically have really good fourth quarters, right? Whereas, if you think about like chocolate, for instance, right? That's probably going to be higher more in, closer to Valentine's Day, right? If you invest in Hershey or something like that. That's going to be more, or Nestle, that's going to be more around Valentine's Day. So really thinking about stuff like that. When you think about a pandemic, though, it's really tough to kind of know when, the floor has come back, right? Because the floor essentially, left and everything started going down last year. And it's kind of starting to do that now. It's really hard to kind of pinpoint when that's going to be over. But that's kind of getting more into, all right, I'm looking at charts. I'm looking at levels to see where everything is. I'm looking at the yearly opens, you know what I mean? Like that's when you start getting into more of that technical analysis. And that's I would say that's more, that's a more intermediary topic. So if you want to talk through some of that stuff, we definitely can talk through it. But it's really hard at the end of the day, even for, you know, really good traders to know exactly where, you know, the floor is going to fall out. But I think overall, what you can do is you can look at things like the fear and greed index and see, all right, well, there's a lot of fear in the market right now. Maybe I should be buying, right? And if you're going to be buying on the way down, one thing I do recommend is buy. If you have, let's say, $1,000 to invest, just put $250 in to start, just so that you can feel out where it's going to be, because it may drop a little bit more. Then put another $250 in, and then it may drop a little bit more and put another $250 in. Then maybe it may go up after that, right? So that way you're kind of hedging your bets a little bit on the way down, and you can also maximize on the way back up.
Okay, I appreciate that, and I think that was what I needed to. That strategy, I think, is what I'm gonna use, because I was pretty curious about that, and I didn't want to miss any, you know, opportunities.
And don't fall into the trap of seeing, you know, red going all the way down. All right, I'm buying on this red, right? Because the next day it might be even more red, right? So I would wait until it starts to kind of stabilize a little bit before I start putting some money in, because it may stabilize and jump right back up, or it may stabilize and keep going back down, right? So you don't want to hit it when it's on like a steep decline. You want to hit it when it's kind of close to that 180 degrees.
Okay.
If possible, of course.
Thanks, Justin.
No problem. Did anybody else have any questions?
Yeah, I had a question. What was the thing you said to pay attention to? I think it was on CNBC. Was there a certain segment? I know you said between like 9:30 and yeah, can you just cover that again?
Yeah. So if you have time during the day, you work from home or something, just turn the TV to CNBC. It's all stocks from 9:30, and it actually starts before 9:30 too. So they have like a pre-market session. But the opening bell and stuff starts at 9:30, and it typically goes until 4 o'clock, 4:30. And then actually, I think it may go to like 5:30, now that I think about it. And then Mad Money, which is Jim Cramer. He's also an analyst on CNBC, and he worked on Wall Street for a little bit. His session actually starts at 6 o'clock Monday through Friday. Anything after that, they're probably gonna get into like Shark Tank or something else like that. So you can watch that stuff if you want, but for the purposes of investing, definitely between, I would say, like that at 6:30 to about 5:30 p.m. You can just have the TV on, and I guarantee you're gonna learn at least one thing. I mean, I've been investing since 2015, seriously, and I learned so much. I mean, even now I could turn on the TV today, and I guarantee I'm gonna learn something new.
All right, appreciate it.
Yeah, no problem, man.
Hey, Justin, I got a question. Well, yeah, I guess it's a question. Have you heard of an app called StockWits?
StockWits?
Yeah.
I've heard of it. I've never used it.
Yeah. I mean, it's like more of a, I don't know how to explain it. It's like an app, like it just tells you about like kind of like the trending different like stocks and like different ETFs and stuff. But it's a cool app, I guess.
Yeah, I mean, a lot of brokerages will have that too. It probably won't look as nice as like a StockWits, but a lot of the brokerages will have that as well. And then there's a lot of like miscellaneous resources that you can use, you know, once you start going down that rabbit hole, right? Like I know there's a joke that Nancy Pelosi is probably the best trader on Capitol Hill, which is actually probably accurate. And you can see all her trades that she does, like she has to report it because she's a public official, just like companies when they buy stocks, or big banks when they buy stocks, they have to report that. It's 3 months delayed, right? So keep that in mind, but they have to report that information or they'll be in violation of the SEC. So There's a lot of websites that'll show you, all right, Nancy Pelosi bought 500,000 shares of NVIDIA. Maybe I should go look at NVIDIA. You know what I mean? Nancy Pelosi bought 200,000 shares of Tesla. Maybe I should go look at Tesla. You know what I mean? So you have a lot of resources like that unless, you know, we have conversations like this, you would never know about. Or unless you just kind of had somebody that had been doing it for a long period of time. I mean, Rich, I started doing options last year, right? And I'm still learning options. But I feel like, you know, as you kind of get your feet under you from a stock investing standpoint, then you can kind of dabble in cryptocurrency, or you can dabble in options, or you can dabble in futures and stuff like that. So, yeah. Any other questions from anybody? All right, cool. So I do want to thank everybody for joining. Hopefully you learned at least one thing from the presentation. Please, if you do have a chance, all right, yeah, before I leave, the question about the young kids. So I actually have one god sister, 2 adopted god sisters, and I actually tried to sit them down and just teach them. There's a book called Why Didn't They Teach Me This in School? I think it is. It's a finance book. And it breaks down, it's very easy to read, breaks down, you know, different things like life insurance. It breaks down, you know, kind of investing as a whole, think about saving, budgeting, things like that, right? So I did use that book, and they did get a lot of good information from that book. But I think too, it's really hard to find a app that'll keep a kid's attention. So what I would recommend parents to do is do things like that 529 plan, or like the custodial account, and let them see what you're doing, right? Let them see that you're making money. Maybe you want them to know how much money you got, right? Because you don't want them to ask for some extra allowance and stuff, but let them see, maybe you want to open up another account, because you can have more than one brokerage account. You don't have to just have one. Let them see like a play account that you want to have in, and let them be able to see, all right, stocks are going up now, right? Stocks are going down now. What companies do you use? Do you play PlayStation? Maybe it has an NVIDIA chip in there, right? NVIDIA is making a lot of money. Look how much money I would have made if I would have invested in NVIDIA, right? So things like that, try to be relatable to them. What I found is that a lot of times they use Instagram, they use Snapchat, but they don't think about it as a company. They just think about it as like a thing, right? A thing that they use on a day-to-day basis. They don't think about, hey, I can own a piece of Instagram by buying Facebook, or I can own a piece of TikTok by buying TikTok. You know what I mean? Like most kids at least don't think about it like that. And I know from personal experience, when I was talking to my little god sister, she didn't think about it like that. And when I told her, she was like, oh, I guess I hadn't thought about that. That does sound kind of cool, but you kind of have to stay on them about it, because sometimes it goes in one ear and out the other. And so it's that consistency, letting them see what you're doing, right? Maybe giving them some money, maybe saying, all right, I'll give you an extra $20, but you can only put it in the stock market. You know what I mean? And then let them see what that money has done over the course of 6 months, or let them see what that money has done over the course of a year or 2 years versus, it just sitting in their bank account. Because once you have, a certain amount of money, especially when you're a kid, in a bank account, it's really not doing anything for you, because the bank account is realistically only going to give you about 0.01% interest. So just letting them see, I think, would be the best advice that I would have, because it's worked for me at least. Any other last questions?
I don't have a question, but I just want to say I appreciate you for dropping all the free gems tonight. Appreciate it for real.
Yeah, man, no problem, man. And if there was anything that, you know, I put it in the survey, but if there was anything that you guys maybe, you know, wanted me to go into more detail on, or if there was any other topics you wanted me to kind of, you know, go into that I didn't cover today, feel free to, you know, just let me know. I posted it in, oh wait, I think I just sent that to one person. I posted in the chat again, but yeah, just let me know, and I can continue to, you know, either make this presentation better or continue to make other presentations, you know, in the future to address maybe more complicated topics that might help as well. Maybe I'll have a kids session to just talk about things that that will be relevant to them and get them interested in it. Maybe that's a good next step. Thanks for the update.
Yeah, I wanted everyone to get the full picture. And so we do appreciate your time. And I wanted to say one thing is that these types of programs are things that, like Justin was saying, even as well-educated Black people, engineers, and other professionals, sometimes some people go like their whole life and don't invest time, no pun intended, into things that do grow your money. And so I appreciated it. And then from the perspective of, like, Justin, I believe was Nesby Jr., went through college into the professionals. And so he is embodying everything that Nesby stands for, and also that Nesby creates leaders. And so I was really glad for him to have a platform, and for him to, like, this is probably something that he'll, you know, take and move forward with in the future, and maybe even be presenting at National Convention or the Professional Development Conference, because, like I said, they don't have these types of workshops. And so with that being said, we present you this virtual certificate of appreciation to Justin Ferguson for being the keynote speaker for the financial literacy program, Money Talk. And like I said, I appreciate your time. And if this was in person, I'd sign it and give it to you in a frame. And so hope to have you speak again in the future.
Yeah, just let me know. I'm around. I'm glad it was helpful for everyone.
Yes.
Thanks to you, Elliot.
Well, with that being said, everyone have a great night. And thanks again, Justin.
All right. Thanks, everyone.